Welcome to the Deep Dive. We're here to cut through the noise and get you straight to the insights that matter.
And today, we've got some pretty big news coming out of Target Corporation.
Yeah, definitely headline-grabbing stuff. They've just released their second quarter 2025 financials, but that's almost overshadowed by a major leadership change.
That's right. So the really big news is Target's board unanimously picked Michael Fidelk to be the next CEO. That's effective August 20th, 2025.
And the current CEO, Brian Cornell, he seems fully behind this.
Absolutely. Cornell expressed, full confidence. He pointed to Fidelk's track record during change, his role in building out some of their key capabilities,
Okay.
and his deep understanding of the business, basically framing it as a move to speed things up, accelerate progress.
And it's interesting how this wasn't, separate news. It dropped right alongside their Q2 earnings.
Exactly.
And those earnings, well, the retail climate is tough, no doubt, but they actually showed some encouraging signs. Better traffic, sales trends looking up a bit.
Signs of recovery, you could say.
So for you listening, this is kind of a perfect storm to analyze. You've got a major leadership handover happening at the exact same time we're seeing how the company's performing financially in this tricky economy.
Yeah, it's a fascinating look at how a giant retailer steers the ship, changes captains, and navigates choppy waters all at once. Real-time retail evolution.
Exactly. So that's our mission today. We're going to unpack the details from Target's official press release, dig into those financial statements.
Right.
We want to give you that shortcut, that inside look at what's really going on. Sales, profits, strategy, the outlook.
All those pieces.
Yeah, trying to connect the dots for you, give you those aha moments without you having to sift through all the dense reports yourself.
Let's do it.
Okay, let's unpack this. Maybe start with the financial landscape Fidelk is inheriting. What did Q2 actually look like?
Okay, so the top line, net sales for the second quarter landed at $25.2 billion.
Right.
Now, that is down slightly, 0.9% compared to last year, 2024.
Okay, so still a decrease.
Yes, but, and this is the important bit, it's actually a nearly 2 percentage point improvement from how Q1 performed.
Ah, okay. So the trend is moving in the right direction.
Exactly. Traffic improved, sales trends improved, especially in the physical stores, and they saw improvement across all 6 of their main merchandise categories compared to the first quarter.
So it feels like maybe some of their strategies, focusing on the store experience, getting inventory right, that's maybe starting to pay off, pulling people back in.
It suggests that, yeah, it's not just a number. It points towards, maybe regaining some traction with shoppers in their stores.
But is that sustainable, do you think, given, like you said, the challenging environment? Or are they still quite vulnerable to, external economic shifts?
That's the million-dollar question, isn't it? I mean, the report does suggest internal improvements, better execution, but yeah, consumer spending is still unpredictable. So they're doing better, but the headwinds are still there.
Right. Okay. What about digital? That's always a big focus.
Digital did well. Comparable sales online were up 4.3%.
Pretty solid.
Yeah, and what really stood out was same-day delivery. That was up over 25%.
Wow.
Powered mostly by that new membership program, Target Circle 360. Plus, drive-up services also continued to show strong growth.
So it makes you wonder, are they deliberately pushing digital hard, maybe even if it pulls a bit from stores? Or is this just consumers voting with their clicks?
Probably a mix. But that emphasis on Circle 360 definitely feels like a strategy. They want to build that loyalty, get those repeat digital buys.
Makes sense.
And it wasn't just about selling stuff. Their non-merchandise sales, up a strong 14.2%.
Oh, interesting. What's driving that?
Mostly things like Roundel, which is their advertising business, that saw double-digit growth. Same for membership fees and their marketplace revenues.
So they're building other income streams beyond just retail sales. That's smart diversification.
Definitely. It cushions them a bit.
Okay, let's shift to profitability then, because sales are one thing, but making money is another. How did the earnings per share look?
Right. So GAAP and adjusted EPS both landed at $2.05 for the quarter.
Which is down from last year.
It is. It was $2.57 in Q2 2024. But the report highlights that strong expense control and efficiency gains helped. They managed to offset some of the ongoing cost pressures, like tariffs.
So they're definitely keeping a close eye on costs.
Very much so.
Yeah.
To dig a bit deeper there, operating income was $1.3 billion. That's down 19.4% from last year.
Ouch.
Yeah. And the operating income margin rate came in at 5.2%, Last year, it was 6.4%.
So what's squeezing the margins?
Well, they mentioned higher markdown rates, so more discounts to move inventory and attract shoppers.
Hmm.
Also, the mix of what people are buying played a role.
Right.
Now, some things helped offset that, like that advertising growth we mentioned, and also lower inventory shrink, which is, theft and damage.
Mm-hmm.
But it really shows that tightrope they're walking. Use markdowns to drive traffic, but it hits your profitability.
Yeah, that's a classic retail challenge. How much do you discount before it really hurts the bottom line? Or do you hold the line on price and risk losing shoppers?
Exactly. And that's going to be a key balancing act for Fidel stepping in. Which path do you lean towards? It's a tough call.
Seems like, for now anyway, they might be prioritizing keeping people coming in, keeping those sales trends improving, even if margins take a bit of a hit short term.
That could be the read, yeah. And looking ahead, their guidance for the full fiscal year 2025, they're actually holding it steady.
Ah, okay. So no big changes there despite the Q2 results.
Nope. Still expecting a low single-digit decline in sales for the year. And the EPS forecast remains $8 to $10 for GAAP and around $7 to $9 on an adjusted basis.
So that signals some confidence, right? That they feel they're on the right track strategically, even with the ups and downs.
It suggests they believe their plan is working, or at least will work, over the full year.
Okay. What about how they're using their cash? Dividends? Buybacks?
They paid out $509 million in dividends in Q2. That's actually a 1.8% increase per share, even though they have fewer shares outstanding now.
So returning cash to shareholders is still a priority.
Seems so. But interestingly, no share repurchases in the quarter.
Even though they have the capacity.
Yeah, they mentioned still having about $8.4 billion left on their current buyback authorization.
So why hold back, do you think? Just being cautious? Saving firepower?
Could be caution, maybe wanting to keep cash handy for investments or just buffering against, potential economic bumps down the road. Hard to say for sure, but it's a data point.
Mm-hmm. And any word on ROIC? Return on invested capital?
Yeah, that measure of efficiency, how well they use their capital, it was 14.3% for the trailing 12 months. That's down from 16.6% a year ago.
Okay, so ROIC down, no buybacks, but dividends up. It really paints a picture, doesn't it?
It does.
You see this huge retailer, Target, dealing with a shifting economy, changing how people shop, bringing in a new leader, all while trying to balance getting people in the door versus making healthy profit on what they sell. It's complex.
It's like juggling multiple things at once under a spotlight. Highlights the pressures on retail right now.
Absolutely. So wrapping this up, let's leave you, our listener, with something to chew on. Okay, so you've got Target focusing on this blend of digital convenience and in-store appeal. They're managing costs tightly. You have a fresh perspective coming in with Michael Fiddelke as CEO, right as they head into crucial seasons like back to school and the holidays.
Big periods for them.
So the question for you is, what do you think will be the single biggest challenge, or maybe the biggest opportunity for Target in the next year? And maybe even what does that signal for the rest of the retail sector? Something to think about.